Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Andrew Krei, Co-Chief Investment Officer at Crescent Grove Advisors. We're going to discuss using strategies in the alternative asset classes such as private credit, hedge funds, and even real estate in client portfolios. Andrew, it's great to have you with us. Welcome to MarketSite.
Thanks for having me.
There's a lot of uncertainty right now, right? The debt ceiling minute to minute. We don't know who's saying what, bank failures, Fed policy. How should investors be thinking about portfolio allocation decisions in this kind of environment?
Sure, yeah, a lot of different headlines at play these days, whether it's the Fed, are they going to pause, are they going to skip, debt ceiling obviously front and center, a lot of uncertainties. So for us, we work with clients that take kind of a 3 to 5 year type of view on the world. So for us, it's kind of zoom out. Back to basics. Do we have the liquidity reserve that we need in the event that we see really heightened levels of volatility? If we see a market drawdown, do you have the cushion that you need for the next 6-12 months to make sure that we're not going to be a forced seller in that type of environment? Do we have the right sort of ballast in the portfolio? Meaning high quality fixed income, things are going to hold up better in a highly volatile equity environment where we can actually go and play offense and be more opportunistic in those types of scenarios too. So for us, it's sort of the preemptive measures that you want to take, the blocking and tackling portfolio management types of considerations for us that we go back to in these periods and try not to get lost in those minute-to-minute details, headlines changing so rapidly.
Let's talk about alternative asset classes. When you think about hedge funds, private credit, real estate, you and I were talking off camera, there's been a number of institutional investor conferences in New York, and I can tell you, private credit and consumer credit have been hot topics at every single one of them.
Yeah, for good reason. I think as you talk about the mini banking crisis that we've had, the regional banks potentially retrenching, you see everybody's talking about the senior loan officer survey, which I've never heard so many people talk about, this sort of niche data point that the Fed puts out. But you're seeing tightening lending standards across the banking system right now. And I think as a result of some of the risk aversion from these banks, you can reasonably anticipate that they're going to pull back or be pencils down for some period of time with their lending. So the natural beneficiary of that, I think, is these private lenders can step into that market. They've got capital available, but they can really dictate terms. So in that case, what are we talking about? That means higher yields, lower leverage points. So really advantageous for investors that can access that private credit space, within the marketplace. We think that's a really interesting segment of the alternative investment landscape, kind of writ large.
What else? I know you're also looking at high quality fixed income and also private equity funds.
Yeah, right. I would say in this environment, it's almost the barbell within fixed income for us. So really meaning sort of from a credit quality perspective, if you think about high quality fixed income, we spent a decade in the 2010s where you're getting nothing, right? And then all of a sudden, now you look around and you say, okay, it's actually kind of interesting. I can own pretty high quality stuff in an investor's portfolio right now and get 4 or 5%. Let's backfill some of those allocations. Let's give ourselves a little more safety. The ballast that I was talking about before, we can build up that portion of the portfolio, which then gives us optionality to play more offense in the future. So I think that's a really interesting piece of fixed income. And then the other side is that private credit segment that I talked about before. Earn those higher yields, find managers that have carved out kind of a niche in that segment. And then private equity, we point to that and say, look, periods of risk aversion historically, periods where you've seen a lot of volatility, you've seen dislocations in markets and sort of capital formation grinds to a halt. Anecdotally, we've heard a lot of managers talking about it's a difficult fundraising environment. Those tend to be your best vintages, right? So we want to kind of lean into that, and those funds get deployed over a number of years anyway. So let's not get too cute about the timing, but let's start to think kind of programmatically about, this is more likely than not an opportune time to start making commitments.
What investor missteps do you notice more? What stands out the most in this current environment?
I would go back to the headline risk. We talked about this idea that at any given point in time, we get a new headline about the debt ceiling, what is going to happen, what isn't going to happen, what's the X date, when's the Treasury going to run out of money. I think we've seen some, cut in the wool investors essentially say, I want to be a trader now because I'm seeing these headlines and I feel like I need to move my portfolio around and be a lot more active, day to day, week to week. Whereas I think if you just kind of step back, continue to play the longer game, and ultimately you can trade, and maybe that's sort of entertainment in some respects, but I think the portfolio churn for a lot of the folks that we work with in particular can be really disadvantageous from a tax perspective oftentimes, and you kind of do more harm than good in many ways in that respect. So I think for us it's kind of zoom out, let's not focus on the day-to-day, let's kind of keep the bigger picture in mind.
Yeah, I mean, it could get quite expensive to your point, and for the past, I would say 2, 3, 4 weeks, the market's been kind of, I don't want to say boring, but There's not much that's really going on. Everyone's focusing on the same thing: debt ceiling and what's happening with the Fed. Earnings, for the most part, are largely over.
That's right.
Not too much really going on.
Yeah, and it's kind of the debt ceiling hasn't really mattered until it matters kind of thing too. I think there is a sense of complacency that they'll get a deal done, and now we slowly creep up, and now you see more research shops talking about, well, that X date is actually, maybe it's a little sooner than we thought it was. I think there could be a real concern building and sort of volatility that starts to build up in the system, where all of a sudden there's sort of the Minsky moment, the breaking point, if you will, within equity markets, where everybody really starts to care about this all of a sudden, and that's when ultimately things come to a head, right?
Yeah, well,
and then
we'll
maybe
start thinking about liquidity at that point, and then we have to start thinking about that.
Right, and maybe that gets the attention of policymakers too, that might be otherwise kind of thinking they've got a little bit more time to let this play out and go through their political theater.
All right, Andrew, appreciate the insight. Thanks for joining us on
Thanks,
Trade
Jill.
Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.